spotlight on GIC Re. The company did come out with a good set. Mr. Hitesh Joshi, interim CMD of GIC Re, joining us on the show. Firstly, help us understand what factors caused the sequential increase in the combined ratio despite the lower loss and expense indicators, and how do you plan to bring back within the 107% guidance?
If we just look back at GIC Re's journey, say from 2020 when the credit downgrade happened, that was an inflection point, and we redefined our risk appetite. And that is a journey of underwriting discipline and focus on pricing adequacy as well as on the value creation. So that journey continues, and now that we have gotten over certain factors which were impacting our results. I think it is very well known to the market that we had this one contract which continued to give us losses on a runoff basis, which was that contract has gone into runoff, and we provided on the reserving side. So having gotten over that particular contract, now we are in a much better place. That the contract tail is all over, and the results that we are getting now is now showing the true underwriting quality of the corporation. Our internal actuarial analysis tells us that there is a distinct, consistent, steady improvement in the attritional loss ratio. So the underwriting discipline that I talked about is now bearing fruits, and we can expect that this will continue. The guidance that we earlier gave at 107%, today, after the end of the second quarter, I would say that we continue to maintain that guidance.
All right. Also, would like to understand what are the key drivers behind the slower than guided domestic and international premium growth, and do you still expect to achieve full year guidance? If so, what will drive the catch up in H2?
See, it is more of a continuation. I think most of the major renewals for domestic market are 1st April, and now we will be focusing on the 1st January renewal. I believe that market would be aware that we got our A- credit rating upgrade in October 24. That was too close to January 25 renewal season. So we couldn't really leverage that particular upgrade restoration of A- credit rating. This year we are going to be able to leverage it. So this January 26 renewal presents an opportunity to get back the business that we had lost, and again grow our international business in a very significant manner.
All right, that's great to hear about your growth and the guidance going ahead. But along with that, wanted to understand which domestic segments underperform related to the internal expectations, and what corrective actions are being taken for the second half.
I would say that broadly, almost entire portfolio has performed exactly as per expectations. If we look at the agri, there was a deterioration of something like 2 to 3%. If we look at the domestic liability and foreign liability, again, there was a higher than expected claims activity. That was because of certain large claims. But as we have been advising our analysts, that 1 quarter or 2 quarter doesn't really give us a good picture. Because see, what is happening on the revenue side, the premium has a particular consistent and steady flow, which can be predicted. But losses tend to be lumpy, because that is the core of our business. That our core of our business is volatility, and lumpiness of losses is a reality. So that is how it happens. So overall, we are quite happy with the way the portfolio performance is shaped up. There are certain segments, but it is well within our tolerance. It is well within our risk appetite. Absolutely nothing to worry about. Our reserving is fairly adequate, so it doesn't give us any surprises from the previous year. Actually, if you look at it from the reserving angle, there is some reserve release from the previous years, which is also aiding the performance of the current quarter.
All right. What structural changes or pricing interventions led to the significant reduction in underwriting losses? If you can explain this, and how much of this improvement is sustainable then?
See, the thing is that, as I mentioned about our underwriting discipline and focus on pricing adequacy and value creation. So that is an ongoing process of recalibrating our pricing tools and algorithm based on constant evolving loss scenarios. And given particular, say, rating trends, if we look at the reinsurance market, 2023 saw the premium rate hardening, which was not seen in previous 2 to 3 decades. And from now, that hardening, very, very hard market of 23 January, there is a gradual softening, but still it is presenting a good overall opportunity in terms of the earning return on equity. So talking about the pricing interventions that we carried out, it is a continuous process based on the, say, a particular class or a particular, say, geography. That process is backed by statistical and actuarial analysis. So it is not that we keep on doing something new every time. It is just evolution and progression of the same process of underwriting discipline, which we embarked on strategically after July 20.
All right, but along with that, what are the top 2 to 3 business levers you expect to materially strengthen the performance in the second half? Second, pricing actions, the product mix, the reinsurance strategy. What is that something that you are aiming for?
As I said, that it is a credit rating upgrade, which we could not leverage last year. We will be able to leverage this year. As far as international book is concerned, January 26 presents a good opportunity for us. We have gotten in touch with the markets where we had a very significant market share, and we have been in constant touch during all this period of 3 to 4 years. So that continues.
Let's also look at the expense ratio in Q2 that, jumped to almost 1.8%. How much of this was seasonal, and what measures are in place to ensure FY26 stays within the 1% range?
The spike that we see in the Q2 in expense is entirely due to one particular tax payment in a foreign jurisdiction, and it is going to be appealed. So there is no material change in expenses of management ratio, and it has to be maintained. This one particular transaction is distorting the picture.
All right, and lastly, what's your outlook on the reinsurance pricing trends in India? Are rates hardening or stabilizing across the key segments like property and health?
I would say that to a large extent, if we look at the broad picture, Indian reinsurance market has to mirror the trends in the global reinsurance market. Apart from that, to the extent there is a presence of the other players, and particularly the new emerging set of players in the GIFT city, the pricing levels can be more competitive, but it will basically mirror the global trend. And as I mentioned earlier, the 2023 did present a very, very hard market. So coming down from there, it is a bit of a price correction. But at the same time, it needs to be emphasized that pricing discipline continues to be maintained by the reinsurers. So the softening will continue, but it will be marginal, and return on equity will come down marginally, but it should still be in a very healthy range.
Sure. All right, that will be all. Thank you so much, Mr. Joshi, for joining in and talking on Q2 results today. Thank you.